Two women live on the same street. Same year, they both pay off their homes completely. No mortgage, free and clear. 10 years later, one of them is calm and secure, sleeping just fine. The other one lost her house. And here's the part that should stop you cold. No bank foreclosed. There was no loan left to foreclose on. So how do you lose a home you already own outright? Stick with me, because buried in this video is a legal move built into the tax code that can wipe out hundreds of thousands of dollars in taxes for your kids. Most people torch it by accident. I'll show you exactly how it works around minute 11. Why most advice is wrong. Here's what almost everyone believes. The day you make that last mortgage payment, you're done. Game over. The house is yours, and you never think about it again. I get why people believe that. I wish it were true. But a paid-off home isn't a finish line. It's one of the most misunderstood assets you'll ever own. And most of the advice out there, including plenty of videos on this exact topic, only gives you half the story. Here's the analytical problem with almost every one of those videos. They treat it like a pure interest rate math problem. Compare your mortgage rate to what you could earn in the market. Whichever number's bigger wins. That's it. That's the entire analysis. But retirement isn't a spreadsheet. It's not just about interest rates. It's about cash flow you can count on, taxes you can control, and risk you can't undo. A 3% mortgage might lose to the market on paper for 20 years, then one bad year comes along, and that clean math falls apart. That's the piece nobody's putting in their video, the invisible paycheck. So let's start with the half everybody kind of gets, but nobody measures. Killing your mortgage erases the biggest bill in your budget. For folks near retirement, that's usually $2,500 to $3,500 a month. Call it $24,000 to $42,000 a year. Gone. But here's the catch. During your working years, that money came from a paycheck. In retirement, there's no paycheck. Every dollar comes from savings, and if it's a traditional 401k or IRA, the tax man takes a bite on the way out. So a $2,500 mortgage might mean pulling $3,200, just so $2,500 is left after taxes. It's quietly costing you closer to $40,000 a year. And here's the wild part. Economists have a fancy name for what happens next. They call it imputed rent. I call it the invisible paycheck. Because if you didn't own that home outright, you'd be paying rent somewhere. A comparable rental in a lot of towns runs $1,400 to $2,500 a month. Your paid-off home hands you that, tax-free, every single month, as a bill that never shows up. If this is already changing how you see your own house, that's exactly why I make these. I'm Sohail, and this channel is about making the confusing parts of retirement simple. If that's useful, hit subscribe so the rest of this actually reaches you. And quick disclaimer, this is for education, not personalized financial or tax advice. Always run your numbers with a professional. Okay, let's get into it. The floor framework, 3 steps. Okay, if the invisible paycheck is real, how do you actually use it? Here's the exact framework. 3 steps, 10 minutes, done. Step 1, guaranteed income. Add up Social Security, pensions if you have one, any annuity income. Write down one number. Step 2, real essential expenses. Not your dream budget. Food, utilities, insurance, healthcare, property tax. The stuff that doesn't disappear. Step 3, subtract Step 2 from Step 1. That's your gap. Most people stop right there and panic. Don't. Because now you add in the invisible paycheck. What your home would cost you to rent, on top of your guaranteed income, before you touch $1 of savings. The Denver couple. Example. Here's why this matters more than almost anything else in planning. Net worth on paper doesn't pay your electric bill. Cash flow does. And most retirement calculators only look at savings. They ignore what your paid-off house is actually worth to your monthly budget. Watch what this does. Picture a couple outside Denver, mid-60s. Combined Social Security, $44,000 a year. Their lifestyle costs $66,000. That's a $22,000 gap. Using the old 4% rule, closing that gap takes a $550,000 portfolio. That's the number that's supposed to keep them up at night, but their home is paid off. A comparable rental nearby runs $2,200 a month, $26,000 a year. That invisible paycheck doesn't just shrink the gap, it erases it. Their real gap isn't $22,000. It's below zero. That's a paid-off home doing the job of a pension nobody gave them. Run this yourself this week. Guaranteed income, essential expenses, invisible paycheck, gap. 10 minutes and you'll see your retirement clearer than ever. But here's the thing. Knowing your gap only protects you from one kind of risk. There's a second one, and it's the one that actually destroys portfolios. It's the one that took down a man I'm going to call Gerald, and it's coming up next. Gerald's story. Sequence risk. Let me tell you about Gerald. Not his real name, but his story plays out every recession. Gerald did everything right. Maxed his 401k for decades, kept a low-rate mortgage because a smart advisor told him the math favored it. He retired at the end of 2007 with $600,000 invested and a $1,400 mortgage payment. On paper, he was fine. Then 2008 hit. His $600,000 dropped to $378,000 almost overnight. But that mortgage payment didn't care. It showed up anyway, every month. So Gerald sold shares into a crashing market just to make the payment. He locked in his losses at the worst possible moment. And when the market roared back a few years later, Gerald wasn't there for it, because those shares were already gone. That's what the pros call sequence of returns risk. A bad market early in retirement, combined with money you're forced to pull out anyway. It's the single most dangerous force in retirement finance. The quiet killer of good portfolios. How a paid-off home protects you. Here's what a paid-off home does about it. It can't stop the market from dropping. Nothing can. But it kills the forced withdrawal. When your biggest fixed bill is gone, a crash becomes something you can wait out, not something that forces your hand. So ask yourself, if the market dropped 30% next year, and someday it will, do you know if you'd be forced to sell or if you could just wait? Most people have never run that number. That's not on you. Nobody ever handed you the worksheet. The tax benefits. Now here's the part. Almost no one connects to this. A paid-off home doesn't just protect your portfolio. It shrinks your tax bill too. Less income means less of your Social Security gets taxed, and it can keep you under the threshold that triggers higher Medicare premiums, a surcharge called IRMAA. In 2026, that kicks in around $218,000 for a married couple, and if you're single, that threshold drops to about $109,000, which sneaks up on more retirees than you'd expect, and lower income in those early years opens up one of the most powerful moves in retirement planning, the Roth conversion. That gap between the day you stop working and the day the government forces withdrawals is often the lowest income stretch of your entire adult life. A paid-off home is what keeps your income low enough to actually use that window. None of this shows up on a balance sheet. But run it across 20 years, and the difference is tens of thousands of dollars. The two quick landmines. Before I get to the big one, let's speed through two more traps, because you need to know them. Landmine 1. Property taxes. You can own your home outright and still lose it because the county doesn't care the mortgage is gone. They still want their check every year. If you can't pay it, they can put a lien on the house and eventually take it. The fix. Almost every state has a senior exemption or tax freeze that most people never apply for because nobody tells them it exists. This week, search Senior Property Tax Exemption plus your state. That one search could save you thousands a year. Landmine 2. Paying off the house the wrong way. Pull $200,000 out of a traditional 401k at once, and that whole amount counts as taxable income in 1 year. You could rocket into the highest bracket of your life and hand the IRS $50,000 or $60,000 just for the feeling of being debt-free. The fix. Spread it out. Pull from taxable accounts first and never let one exciting decision blow up your tax bill. The secret weapon. Step up in basis. All right. Remember what I promised you at the start. The secret hiding in the tax code? Here it is. It's called the step up in basis, and it's one of the most powerful, least understood gifts the government ever built into the code. When you pass your paid-off home to your kids after you're gone, the IRS resets the home's value to whatever it's worth on the day you die. Say you bought it for $80,000 decades ago, and it's worth $500,000 when your kids inherit it. That $420,000 in gain can legally vanish for tax purposes. Your kids could sell it the next month and owe next to nothing in capital gains. That's one of the largest wealth transfers available to an ordinary family, and almost nobody talks about it. The trap that destroys the secret weapon. But here's the trap. A lot of well-meaning parents hand the house to their kids while they're still alive, thinking they're being smart. Do that, and you can accidentally hand your kids your old, low purchase price right along with it, wiping out the step-up and sticking them with a massive tax bill on a gain they never asked for. So before you ever put a child's name on your deed, talk to an estate attorney first. What feels generous in the moment can quietly become one of the most expensive mistakes a family ever makes. And this ties right back to the widow's penalty. Married couples shield $500,000 in gain tax-free when they sell a home. But if one spouse passes, the survivor has 2 years to sell and keep that full exclusion. Miss it, that shield cuts in half. Right when they're already grieving. Same tax code, same kind of trap, which is exactly why this needs to be a conversation now, not a surprise your family finds later. Pulling it all together. So here's the real thread through everything today. A paid-off home isn't a trophy. It's infrastructure. It pays you an invisible paycheck. It protects your portfolio from being sold at the worst possible moment. And it can shrink your tax bill and hand your kids a legacy almost tax-free. But none of that happens automatically. You have to protect it from property tax. Plan around the widow's penalty and pay it off the smart way instead of the expensive way. And if you want your own floor number without wrestling a spreadsheet, the retirement budget calculator I built is linked below. 10 minutes and you'll see your exact gap in black and white. Now, that landmine about paying off the house from the wrong account, that's connected to something even bigger. The exact order you should pull money from your accounts in retirement, because that one decision can swing your lifetime tax bill by 6 figures. I break down that whole order in the next video, right here. Because here's the truth nobody tells you. The woman on that street who kept her house didn't get lucky. She just knew which accounts to protect and when to move. And the one who lost hers made exactly one of the mistakes we just walked through. Because 2 women, same street, same paid-off house, can still end up in 2 completely different places.